Good morning. This is Dr. Dennis Foster, the W.A. Franke College of Business at Northern Arizona University. It's always a pleasure to be able to speak to you at this conference, although with this virtual format, it's going to be a new experience for us. Instead of looking out across a crowded meeting room and seeing your reactions, I'll just have to assume that you're nodding your heads in vigorous approval to all of my comments. 2020 has been a very traumatic and awful year, but you probably already knew that, and we still have the better part of 2 months to go. Our economy is, in a word, a mess. Why is that? Well, fundamentally, I would argue that it's because the public in general and politicians in particular just don't trust markets. They don't understand how markets aggregate information on the availability of hundreds of resources from thousands of places around the globe and synthesize that into prices, which are used to guide decisions of billions of consumers and millions of producers. Instead, there is the notion, a delusion really, that government, be it in the form of a nation or a state or a city, knows what is best for us and can rationally and efficiently make choices for us. Of course, they can't. And indeed, when they try, at a minimum, they worsen the uncertainty that we already have to deal with in coping with the world around us. Our experience with the coronavirus has greatly magnified that uncertainty. But I don't see any particular trend away from the government assuming more and more control over the economy. In this regard, I completely agree with Nobel Prize-winning economist Milton Friedman when he wrote, quote, "The role that government should play in a society dedicated to freedom is to rely primarily on the market to organize economic activity." End quote. His point is worth taking seriously and worth an extended discussion. We have just had an election. At the time I'm recording this, there is still a great deal of uncertainty about many of the outcomes across the country. I think the only certainty is that recreational marijuana is now going to be legal in Arizona, which will present Joseph with some interesting challenges for next year's Economic Outlook Conference, especially if this continues to be a virtual event. But this election has once again validated what we all know, that we live in a very divided country. It has been that way for a while, and it has worsened, I believe, because we have not embraced Friedman's vision of the proper role and relationship between the government and the market. Let's dig a little deeper into Friedman's insights here. From his book, Capitalism and Freedom, published some 60 years ago, Friedman wrote the following: "The use of political channels tends to strain the social cohesion essential for a stable society. The strain is least if agreement for joint action need be reached only on a limited range of issues on which people in any event have common views." He goes on to add, "The widespread use of the market reduces the strain on the social fabric by rendering conformity unnecessary with respect to any activities it encompasses." I believe we would be a much healthier and peaceful society if we would embrace Friedman's perspectives in these matters. So on to the data. Here is a chart of real GDP over the last 5 years. The recession this year was sharp and dramatic, a decline of over 30% on an annual basis in the second quarter of the year. But the news for the third quarter was quite heartening, with the Bureau of Economic Analysis showing a 33% increase in annual terms. Some have argued that our recovery would be V-shaped, and certainly that is the case as of right now. Whether that continues, though, will depend on a lot of ifs. And here is a chart showing the flip side of the output story, and that is the unemployment story. I have the monthly data shown here going back to 2017. You can see that the best figure was just as the pandemic began in February, ringing in at 3.5%. By the way, the last time the measured unemployment rate was that low was December of 1969. The monthly rate peaked in April at almost 15%, and since has come down to a bit under 7% in October. We can keep our fingers crossed that this trend will continue. For some years now, I've been bringing up the point that we need to be concerned about slowing economic growth. It's not only an expression of our overall ability to raise our standards of living, but it's absolutely crucial towards alleviating many social concerns, be it income inequality or crime or keeping families together. In other words, reducing the strain on social cohesion that Friedman wrote about. Here are the growth rates for real GDP by quarter at annual rates during each of the past 4 recovery phases of the business cycle. I've identified them by presidential terms, showing the aggregate growth and the number of quarters that the recovery lasted. And here are the average annual growth rates for each of the recovery phases. You can see that it was over 4% per year in the 1980s, and then it declined steadily to the point where during the last recovery phase, it was merely 2.3% per year under Presidents Trump and Obama. I continue to believe that this is the single most important issue facing our economy, and it does seem to be mostly ignored. Here is the story for inflation, measured by the CPI going back for the past 20 years. You can see the spike at 5.5%, which is in July of 2008, as the recession at that time was getting started, and shown by the gray shaded in bar on the graph, and the low point of minus 2% in July of the following year. Currently, we're at 1.4% measured as the year-over-year change. I've highlighted 2% here as that's the target rate of inflation that the Federal Reserve has set. And that leads to a question. And that is, why is the Fed pursuing 2% inflation? It's a very good question, and I think I pretty much ask this every year. Here is the legislative mandate to the Federal Reserve. The Board of Governors shall maintain long-run growth of the monetary and credit aggregates so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. And here is their justification as published by the Federal Open Market Committee, which determines monetary policy. The FOMC judges that inflation at the rate of 2% is most consistent with the Federal Reserve's mandate for price stability. Now, the meaning of stable prices does not mean 2% to me. If you think that this is a bit of double talk, well, you're not alone. In fact, here's what Robert Heller, a former member of the Federal Reserve Board of Governors, wrote a few years ago. Does the Fed really want to increase annual inflation to 2% such that the price level of the country will increase by more than 700% over the next century? Is that what Congress had in mind when it tasked the Fed with achieving stable prices? Well, I think that the answer is no. During the recent presidential debate, I counted up how many times that the candidates were asked about this. Of course, the answer was 0 times. And if you can believe this, it actually gets worse. At their September 2020 meeting, the FOMC included this in their press release. With inflation running persistently below this longer-run goal, the committee will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time. So what does that mean besides just that they're now willing to let inflation go higher than 2%? How much higher? What is the time frame that they want to use to determine the average? Is that going to be 6 months or a year or 5 years? We have no idea, and quite frankly, neither do they. The story on interest rates continues from last year. They're going down. Here's the 30-year fixed mortgage rate of interest over the last 20 years. You can see it was 8% back then, fell during the recession of 2001, rebounded a bit, and then fell again with the recession of 2008-2009. It had been trending up as the Fed was pushing rates higher in 2017 and 2018. But since late 2018, the Fed has been pushing rates down, and you can see that this rate was at 2.83% as of October. The 10-year U.S. Treasury bond follows the same general path, but a couple of percentage points below the 30-year mortgage rate. It is currently at 0.79%, which is likely to be a negative real return since inflation has been higher, as we've just seen. And then at the short end of the maturity spectrum are 3-month U.S. Treasury bills. They track almost perfectly with the Fed's manipulation of short-term rates. As you can see, this is also peaked in late 2018 and now has shot back down, currently standing at 0.1%. in October. Now, I really don't need to tell you that this is unsustainable, but it is. As a borrower, I certainly don't mind paying lower interest rates. Of course, this is terrible news for savers, but they seem to be ignored by the media, by politicians, and even by the Federal Reserve. But there is another problem here, which gets back to my earlier point about economic growth. Low interest rates discourage saving. Less saving means less investment and less capital. Less capital means our economy doesn't grow as fast as it would without these interventions. The Federal Reserve's primary objective is the federal funds rate of interest, which is the rate at which banks lend to and borrow from each other, generally just for overnight. This chart shows the federal funds rate going back to 1980. You can see that what they do is they lower that rate with the onset of each recession and push that rate down. Their hope is that lower interest rates will stimulate more lending in the economy and more spending. But we see that over the past 4 recessions, the Fed has pushed this rate lower and lower and kept it there longer and longer. With the current recession, the rate was not very high to begin with and is now back to about zero as of the second quarter of 2020. Now, this explains why the Federal Reserve wants there to be 2% inflation. While they can only push the nominal interest rate down to zero, if the rate of inflation is plus 2%, then they can push the interest rate in real terms down to minus 2%. Now, if you think that sounds like a horrible policy idea, well, so do I. Turning to fiscal policy, this chart shows growth in the public debt relative to GDP. We can see that it crossed over the dreaded 100% mark a few years ago, and in the second quarter of this year, it's risen to a shockingly high rate of 135.6. We used to think that this was territory reserved for truly basket case countries like Greece and Italy and Portugal. Well, I guess not anymore. By way of contrast, the peak in this measure at the end of World War II for the United States in 1945 was 112.7%. This past September, the Congressional Budget Office published a report forecasting economic conditions to 2050, assuming no major changes in Congress with regard to taxing and spending. They project the public debt will double to 200% of GDP. Federal spending will rise to about 30% of GDP. Tax revenues will be about 18.4% of GDP, and the interest on the national debt will absorb 6.5% of GDP. My conclusion from all this is that we're certainly in an economic mess. As to my outlook for the coming year, I think we have a 50-50 chance that the recession will continue and maybe even worsen. The expectation for 2020 is that we'll end up at about minus 4% for GDP. I would say that in the next year it may be just as bad, although perhaps not as volatile, with growth being between negative 5% and maybe plus 1%. In terms of interest rates, I don't see any change in the Fed's policies, barring some dramatic change in inflation. I expect that the target federal funds rate will stay well below 1%. I think inflation is going to be the wild card. A continued recession would normally dampen prices, but the continued political support for relief spending will likely push prices the other way. We may still see hot sectors like we've seen with housing, although that could change at any time. And the stock market could keep going up as long as there's increased liquidity in the financial system. I see the CPI coming in next year between plus 1 and plus 8%. If I may channel the rock band The Who, when we get to January, I think we'll be saying, meet the new year, same as the old year. Perhaps a good way to sum up this year is with a meme I saw. Yeah, that pretty much sums up 2020. Thank you very much for your time and attention. Stay healthy and safe, and enjoy the rest of the conference.